Konnichiwa and Salam Alaikum. In the UAE this week there's been ongoing dissemination between the ADX and the DFM bourses, with the DFM stocks generally weakening and the ADX stocks generally more stable. The DFM index at the moment is 1,565 and the ADX index is 2602. Largely sparking the sell down in DFM stocks this week has been concerns over the liquidity and cash flow position of Union Properties, and this has reverberated through other property companies such as Emaar and Arabtech. In corporate news this week, the Telecommunications Regulation Authority, or TRA, has outlined a proposal that means that telco operators Du and Etisalat are free from applying for regulatory approval before changing their rates on mobile, fixed line and internet packages. The proposal is aimed at increasing competition amongst the two operators, and we expect that once it's approved, stronger competition will emerge, particularly in the mobile space, and eventually greater competition also in the fixed line and internet/TV rates. As a result, we see some medium-term erosion in profit margins for both players, in particular Etisalat, that has the dominant 70% market share of the local telco industry, where the EBITDA margins are a world high 65.7%. And we also expect greater emphasis on reducing cost overheads between both players. At present, Du is winning customers and market share from Etisalat due to its more targeted and attractive marketing campaigns. Importantly, Du and Etisalat are aiming to share a lot of their infrastructure from 2010 onwards, which highlights the cooperation between the two players. And overall, because both companies have high government shareholdings, we do not expect that the competition as a result of this regulation will be as aggressive as what would be in other markets around the world. Ports operator DP World has reported full year 09 volume figures for containers. In the consolidated ports, container volumes declined by 8% year on year to 26.5 million TEU, which is above the industry average of a decline of 11% around the world. The declines represent the weaker shipping conditions and also a slowdown in global GDP and trade growth. The Middle East and Asian regions continued to outperform Australia, Europe and Americas, and importantly the volume declines experienced during the first half of 2009 started to slow, creating a more stable container volumes picture looking forward. We believe that this creates a more positive earnings framework for DP World heading into 2010, and for 2009 we expect the company to register a profit pre-minorities of $323 million, as the company has successfully implemented cost-cutting programs which have protected profit margins in spite of the decline in volumes and revenue. Looking ahead, DP World is progressing with new terminal capacity in India and Peru during 2010, in addition to the recent additions of Vietnam during 2009, and the company aims to spend $2.5 billion on terminal expansions and capex between now and 2012, as the TEU capacity is increased towards 95 million by the year 2017 to 2018. With global GDP rates trending positive for the next 12 months, we believe the trade conditions will continue to support an increase in throughput volumes of between 3 to 5%, and gradually improve confidence among shipping players, which will mean that they demand a higher rate of the ancillary services provided by DP World, which comes at a higher profit margin to DP World. DP World's proposed dual listing on the London Stock Exchange is also on track for the second quarter of 2010, and we expect that this listing will give it a greater audience of investors in Europe and America and underpin greater liquidity in the stock. On balance, we've increased our 12-month price target to 66 cents per share, representing strong upside for investors at current levels. Looking at Union Properties, or UPP, We recommend that investors switch out of this stock and into more cash flow positive companies with a more transparent earnings structure, such as Agthia, Air Arabia, Dana Gas, DP World, Aramex, or even RAC CC for the attractive 10% cash dividend. UPP has a large debt balance of $6.8 billion, which is over 3 times the company's market cap. Combining this with weak cash flow generation and the fact that the company posted a loss of $350 million for the 9 months ending 30th of September due to higher provisions and also loss of fair value on investment properties. Earnings are likely to continue deteriorating over the next 2 to 3 quarters given the weakness of the Dubai property market and also lower demand for projects. At the moment, UPP has 10.2 billion dirhams worth of properties under development and another 3.4 billion worth of investment properties. However, with the value of these written down and a lack of demand, it is difficult to see the company being able to wind up these projects and receive fair value for it. Therefore, we believe that profits will be adversely affected over the coming quarters. Food and beverage company Agthia has reported full year 09 earnings of 106.4 million dirhams, marginally below consensus estimates. Revenue rose by 12%, driven by higher production volumes in the bottled water and also the feed and flour, and also an enhancement in profit margins flowed through to earnings, driven by cost efficiencies in the supply chain and lower wheat inputs and steady flour selling inputs in the feed and flour division. Agthia has not declared a cash or stock dividend. With earnings per share of 0.17, the company is priced on a price to earnings ratio of 10.3 times, which represents strong value for a company with a high quality of earnings, clear capacity to ramp up its production rates and drive volume growth, and high market share and growing export penetration around the GCC. At last price of 1.79, we believe that the company can trade up to 2.5 dirhams over a 12-month basis. In the banking space, Abu Dhabi Commercial Bank has reported a full year loss of 513 million dirhams, based on it having to write down 3.9 billion worth of its loan portfolio due to its exposure to Saad and Al Ghasaibi in Saudi Arabia, and also a deteriorating domestic credit portfolio. The bank reported a 9% gain in revenue to 4.8 billion despite the losses, highlighting that the lending activities continue to grow at a rate of 10%. Capital adequacy is a high 17%. Despite the obvious weakness in the result, ADCB appears to have now provided for the bulk of its exposure to Saad and Al Ghasaibi and has a more clean slate heading into 2010. However, we have to also remember that the company has 1.9 billion US exposure to Dubai World, which may need to be written down, or a portion of it written down, due to the weakness in that group. At last price of 1.37, the bank trades on a trailing 08 PE of 4.7 times, at a discount to the rest of the banking peers, reflecting the higher risk and speculative profile of the bank. We continue to prefer NBOD and First Gulf Bank in the banking space. Cement operator RAC CC has also reported its full year 09 results. Net profits declined by 10% to 72 million dirhams on revenue declines of 33% to 283 million dirhams. The company reported earnings per share of 15 fils and declared a cash dividend of 10% of par value, meaning that for every share you own you'll get a 10 fil dividend. This equates to a very attractive cash yield of 10%. Investors have up until around the 26th of February 2010 to buy the stock and hold to gain access to this dividend. And we believe that with the current weakness in the ADX and DFM indices, now is the best time to buy RAC CC and hold for this cash dividend upside, as it represents strong annualised returns in a short space of time. Operationally, RAC CC has virtually no debt and a cash balance in the range of 70 to 80 million dirhams. Although revenue has declined, cement input costs have also declined, meaning that profit margins have reduced by less than revenues. The company is also more exposed to the Abu Dhabi property market than Dubai, which has held up relatively better, and paying out 60% of its earnings as a dividend also highlights the confidence that management have in the business over the coming 12 months. So that's all in the UAE markets this week. Happy investing, El Larika, and Sayonara!